Hey everyone, welcome back for another deep dive. Today we're tackling something I'm sure is on a lot of people's minds with all the craziness going on in the markets. How to protect your wealth in 2025. We've got reports analysis, all sorts of stuff, and we're going to break it down and give you some actionable strategies for dealing with all this.
Right.
The source we're looking at today is calling it an inflation beast.
Oh, wow.
And honestly, they're not wrong. They're saying global average inflation is going to be 6.5% this year.
Wow.
And some countries are getting hit even harder.
So what's really interesting here is it's not just prices going up a little. We're talking 6.5%.
Yeah.
Which means if your earnings or your savings aren't growing at least that fast, your money is actually losing value. You can buy less with the same amount you had last year.
Yeah, that's a scary thought. It's like your wealth is slowly evaporating. So how do we fight back? Where do we even start?
Well, this source jumps right into investment strategies that can help outpace inflation. And their number one point is diversification. Don't put all your eggs in one basket, as the saying goes.
Makes sense. Spreading the risk, right? But what are some of the specific baskets we should be looking at?
Well, one they highlight is real estate. They point out that historically, property tends to appreciate faster than inflation.
Okay.
And they cite an average appreciation rate of 8% annually over the last decade, which significantly beats the current inflation rate.
Wow, 8%. That's a big difference. I can see why they're pushing real estate, but what about those of us who aren't ready to become landlords or buy a whole building?
They actually address that, suggesting that
The REITs.
real estate investment trusts
Okay.
are a good option for folks who want exposure to the real estate market without the huge upfront investment. It's like owning a tiny sliver of a lot of properties.
REITs. Got it. So that's one basket. What else should we be considering to build a diversified portfolio?
They go on to talk about inflation-linked bonds, particularly TPS, Treasury Inflation-Protected Securities. The cool thing about these is that their returns adjust based on inflation.
Okay.
So as inflation goes up, so does your return, offering some protection against that shrinking buying power we talked about.
Okay, that sounds like a pretty clever safety net, but are there any downsides to TPS? Like, what happens if we somehow end up in a deflationary environment? Do they lose value then?
That's a great question. And it's something they don't really touch upon in this particular source. It is worth noting that TPS are designed specifically for inflationary periods. In a deflationary scenario, their performance would likely be less impressive compared to traditional bonds. They also have specific tax implications, which might not be suitable for everyone. It's definitely something to research further based on your individual financial situation.
You're right. It's always best to do your due diligence before jumping into any investment,
Right.
no matter how promising it seems.
Absolutely, informed decisions are key. And of course, no discussion about hedging against inflation would be complete without mentioning commodities, especially gold.
Ah, yes, gold. It's often touted as a safe haven, but I've also heard people say it's a volatile and unpredictable investment. What's the real story here?
That's where things get interesting. The source presents gold as a sort of historical safe haven, something people flock to when the economy gets shaky because it tends to hold its value better than other assets.
Right.
But, and this is important, its performance can be very erratic. They give the example of investors who saw a 12% gain in their portfolio in 2024, thanks in part to gold and real estate. But they don't mention the folks who might have lost money betting on gold during a different period.
So it's not a guaranteed win. It sounds like there's more nuance to it than just buy a gold and you'll be fine. It probably comes back to diversification again, right?
Exactly. Having gold as part of a well-diversified portfolio might make sense for some people, but it's definitely not a one-size-fits-all solution. And that leads us to some common pitfalls that the source highlights.
Okay, pitfalls. Now, this is something I definitely want to pay attention to. What are some of the traps we should be watching out for?
Well, the first one might surprise you. Holding on to too much cash.
Wait, really? I always thought having cash on hand was a good thing, especially during times of economic uncertainty. Isn't it like having a safety net?
It is to a certain extent,
Yeah.
but the source emphasizes that during periods of high inflation, keeping too much money in a savings account that's earning a tiny amount of interest means it's constantly losing purchasing power.
Okay.
That cash isn't growing fast enough to keep up with the rising prices.
So it's a balancing act then. You need some cash for emergencies, but you don't want it all sitting there doing nothing while inflation eats away at its value.
Precisely. And the second pitfall, which we already touched upon, is ignoring diversification. Putting all your money into a single asset class, even one that seems strong, leaves you extremely vulnerable to market fluctuations. Remember, growth-oriented stocks, which are generally companies expected to grow at an above-average rate, can offer high returns but also carry higher risks, while defensive assets like consumer staples or utilities tend to be more stable but might not grow as quickly.
So it's like building a team with different players who have different strengths. That way, no matter what the market throws at you, you're prepared. The source actually quotes some expert advice on this, right?
Yes. They emphasize finding that sweet spot, balancing those growth-oriented stocks which have the potential for higher returns with more stable defensive assets that can help you weather market storms. You want to be able to play both offense and defense, so to speak.
That's a helpful way to look at it. Finding that balance is key.
Absolutely. And speaking of balancing, now that we've covered the basics of diversification and some of the pitfalls to avoid the source, takes us into an exciting concept: generating passive income streams as a way to potentially outpace inflation.
Now, passive income is something I've always been curious about. The idea of earning money without actively working for it sounds pretty amazing, especially during times of high inflation. Is that even realistic?
It is, but it requires a shift in mindset and some strategic planning. This is where things get really interesting, so let's dive in.
So the source is painting this picture of passive income as a way to potentially outpace inflation without needing to work harder. That's a powerful concept. But how exactly does it work? What are some of the avenues they suggest exploring?
They start by highlighting a classic: dividend stocks. These are stocks of established companies that pay out a portion of their profits to shareholders regularly.
So if you own these stocks, you get like a little bonus payment just for being an owner. But isn't that risky? What if a company's profits take a hit?
That's a valid concern, and it's why the source emphasizes choosing companies with a solid track record of dividend payments, those with a history of stability and consistent performance. They even suggest looking at dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. That kind of track record shows commitment to their shareholders and resilience even during tough economic times.
That's a great tip, looking for those dividend aristocrats. It adds another layer of security to the whole dividend investing strategy.
Exactly. And even though those dividend payments might seem small individually, over time they can accumulate to a significant stream of income, especially if you reinvest those dividends, buying more shares, and creating a compounding effect.
It's like a snowball effect,
Yeah.
gaining momentum over time. What other passive income strategies does the source recommend?
They also highlight rental properties,
Wow.
a time-tested method of generating passive income.
Okay.
It's the classic be a landlord approach, but it doesn't have to be as hands-on as people might think.
Yeah, that's what always held me back from considering rental properties. The idea of dealing with tenants and repairs and all that hassle just seems overwhelming.
I hear you.
Right.
But the source points out that you can hire property managers to handle the day-to-day tasks,
Oh,
leaving you to collect the rent checks.
hey.
They even provide a quick tip: focus on properties in areas with strong rental demand and low vacancy rates to maximize your returns and minimize the stress of finding and managing tenants.
Now that makes it a much more appealing option. So we've got dividend stocks, rental properties. What other avenues for passive income did the source mention?
They dive into the exciting world of online businesses and royalties.
Oh, okay.
Think digital products like ebooks, online courses, or even stock photography. You create something once, and it potentially keeps generating income for you long term.
It's almost like planting seeds that keep producing fruit without needing to constantly replant. That's a fantastic analogy. What about royalties from music or other creative works?
That's in there too.
Yeah.
The source emphasizes that with the digital landscape constantly expanding, the possibilities for passive income in this realm are truly limitless. It's all about finding your niche, creating something valuable, and leveraging the power of the internet to reach a global audience.
I love how they're not just focusing on traditional methods, but also embracing the potential of the digital age. It really does feel like a whole new world of possibilities is opening up. To really bring this concept to life, the source shares a compelling success story, right?
Yes. They feature a small business owner who, back in 2023, made a conscious decision to start building passive income streams through dividend stocks and rental properties.
Okay.
They were looking ahead, recognizing that relying solely on their active income might not be enough to secure their financial future, especially with inflation looming on the horizon.
That was a smart move. So how did it turn out for them?
Well, guess what? They now earn a whopping 25% of their monthly income passively, which provides a significant buffer against inflation's impact.
That's impressive. But I'm curious, was it challenging to reach that 25% passive income level? What hurdles did they have to overcome? Did they have any advice for others looking to follow a similar path?
The source mentions they initially faced some challenges, like learning the ropes of real estate investing and finding the right tenants.
Yeah, makes sense.
They stress the importance of research, networking, and being patient. They also highlighted the value of starting small and gradually scaling up your passive income streams as you gain experience and confidence. Their biggest piece of advice was to treat it like a business, setting clear goals, tracking your progress, and constantly learning and adapting along the way.
That's really inspiring. It shows that with some planning and effort, passive income can become a real game changer. And it doesn't have to happen overnight. It's about taking those small steps and building over time.
Exactly. And another point the source emphasizes is that you don't have to choose just one path. You can diversify your passive income sources, just like you diversify your investments. Maybe you start with dividend stocks, then dip your toes into creating a digital product, and eventually explore rental properties. The key is to find what aligns with your interests, skills, and risk tolerance.
It's all about crafting a personalized strategy that works for you. And speaking of personalized strategies, the final point the source touches on is the importance of leveraging technology to stay ahead of the curve. I'm all for using tools to make life easier, but how exactly can tech help us fight inflation and protect our wealth?
There's a ton of apps and online tools that can help you track inflation trends, manage your investments, and even get insights into potential future economic shifts.
Good to hear.
It's like having a personalized financial dashboard right at your fingertips.
So are we talking about those budgeting apps that help you track spending, or are there more sophisticated tools designed specifically for investors?
It's a whole spectrum. There are apps for budgeting, sure, but the source highlights tools specifically for investors, particularly those focused on portfolio management and analysis. These apps can provide real-time information and personalized recommendations, empowering you to make more informed decisions about your investments.
That's really cool. It's like having a personal financial advisor in your pocket, but without the hefty fees. Are there any specific types of apps the source called out as being particularly helpful in the fight against inflation?
They specifically mention apps that offer inflation alerts, so you can stay updated on how prices are changing in your area or for specific goods and services that matter to you. They also highlight apps that offer portfolio balancing suggestions, which can be incredibly helpful for making sure your investments stay aligned with your risk tolerance and financial goals as the market ebbs and flows.
That's incredibly practical. No more getting blindsided by sudden price hikes or making impulsive investment decisions based on fear or market hype.
Exactly. Technology can be a powerful ally in navigating the complexities of the financial world. And the Force wraps up this section by encouraging listeners to embrace these tools, experiment with different apps, and find what works best for their individual needs and goals.
It's like they're saying, don't be afraid to explore and harness the power of technology to your advantage. This has been incredibly insightful. We've covered so much ground, from understanding the current inflation landscape to building diversified portfolios and even generating passive income streams.
Yeah.
And let's not forget those handy tech tools that can help us stay one step ahead. It feels like we've been given a whole toolbox to navigate this challenging economic terrain.
And that's precisely the goal of these deep dives, to empower you with the knowledge and resources you need to make informed decisions about your financial future. We're not just presenting information, we're equipping you with the tools to take action.
So, as we wrap up the section on passive income and leveraging technology, we want to leave you with a question to ponder, a question that goes beyond just summarizing what we've discussed and instead challenges you to apply this knowledge to your own life. Think about your own financial goals, your current situation, and your risk tolerance. We just explored a ton of different strategies to combat inflation and protect your wealth, from building a diversified portfolio to generating passive income streams and harnessing the power of technology. It can feel a bit overwhelming.
Yeah, for sure.
Yeah.
It's definitely a lot to take in, especially if you're just starting to think about these concepts.
Yeah.
But the source does a great job of breaking it down into manageable steps.
Right. We ended the last segment with that thought-provoking question. Which of these strategies resonates most with you? What small step could you take today to start building your defenses against inflation?
It's so easy to get caught up in the information overload and feel paralyzed by indecision. But the key takeaway here is to focus on taking action. Even if it's just one small step, progress over perfection, as they say.
I love that. Break it down into bite-sized actions. So maybe today you spend 30 minutes researching those REITs we talked about, or you explore a couple of those dividend aristocrats, Or perhaps you just brainstorm some digital product ideas that could potentially generate passive income down the road.
Exactly. The point is to get the ball rolling. Don't wait for the perfect moment or for all the stars to align. There's no time like the present, especially when it comes to protecting your hard-earned money.
Because let's face it, with inflation on the prowl, the best time to act is now. And here's another key point from the source. You don't have to go it alone on this journey.
Absolutely. There are so many resources available to help you, from financial advisors to online communities to books and podcasts like this one. The key is to stay curious, stay informed, and most importantly, stay empowered.
Knowledge is power, especially when it comes to navigating the complex world of finance. And that brings us to the source's final message, which I found really inspiring. They remind us that while the economic landscape might be uncertain, we're not just passengers on this financial roller coaster.
They emphasize that we have the power to make choices, to take control of our financial destinies. With the right knowledge, a bit of courage, and a willingness to adapt, we can navigate these challenges and emerge stronger on the other side.
It's like they're saying, don't be afraid of the unknown. Embrace it. Learn from it. And use that knowledge to build a more secure and prosperous future for yourself.
Exactly. And as we wrap up this deep dive into protecting your wealth in 2025, we want to leave you with a sense of optimism and possibility.
Yes, remember, the information and strategies we discussed today are just the starting point. It's up to you to take this knowledge, apply it to your unique situation, and create a financial plan that aligns with your goals and values. Keep diving deep, keep learning, keep asking questions, and most importantly, keep taking action. We'll see you in the next deep dive.